All right, and we are live. How you doing today, Mike?
Good. How about yourself, Parviz?
Doing very well, thank you. So welcome everybody to the Parviz Malakouti Speaker Series. My name is Parviz Malakouti. I am an attorney, practicing attorney licensed in the state of California. I practice primarily in immigration, but as you guys know, I like to interview professionals and experts as well. Today we have an insurance expert, Mike Alavi. He is the owner of Apartment and Building Owners Insurance Agency. He has an ARM, which is an associate risk management. He's also a good friend of mine as well, and I'm very happy to have him here today. Welcome, Mike.
Thanks for having me, Parviz. We've been talking about this for a few weeks, so I'm happy that we got it set up, and I'm happy here to speak with you.
Thanks. I'm really happy that we got it set up as well, and I think I'm going to drag a lot of really good information out of you today. So before we go on any further, I'm just going to lay out the structure of the interview. We're going to have 4 parts of the interview. First, we're going to go over your personal background, education, and professional experience. Then we're going to go into what to look for when somebody is shopping for an auto insurance policy. Then we'll go over homeowners insurance policies. Then we'll go over a topic that I know you are especially passionate about, which is apartment building owners, how they should look for a policy and how
what gave it away.
Exactly. So for those of you who are listening, if anybody wants to skip ahead from the personal information, they're welcome to do that. And I'm going to mark it in the video so it's easy to get to the substance if they want to. But they should stay tuned and get to know who Mike Alavi is. So, all right. So, Mike, let's start from the very beginning. Where were you born?
I was born here in Northern California in the East Bay area, tiny little town called Martinez, California, which is the county hospital for Contra Costa. And so I've pretty much grown up between Contra Costa. I went a little bit inland for my high school days and then came back to Alameda where I finished up my university.
Okay, great. So that brings us to the next point. Where did you end up going to university?
I went here in UC Berkeley, California.
Okay, yeah, UC Berkeley is an excellent school, even the top-ranked UC, so very good.
I appreciate it. I think we're neck and neck with UCLA, so let's just say it's equal at the top. How about that?
All right. I like that. So you are ethnically half Iranian and half American, is that correct?
That's correct, sir.
And I hear that's a very good mix, huh?
It's the best. No complaints here.
All right, very nice. Mike, when did you graduate from UC Berkeley?
I graduated UC Berkeley in 2008.
2008, okay. What'd you end up doing right after graduation?
So I had bought a ranch with my father. You know, I'd grown up from a farm background. And we bought the ranch in right around when I was graduating. And I helped him run the place for about a year. And then about a year in, I decided it's going to be better off if I pursue my own career and then just contribute to that project purely financially.
So does that mean that initially your interest was actually kind of living off the land and being a rancher professionally?
Yeah, I mean, it's something that I'd say that's where my focus was right when I was finishing up school. Ranch project really excited me. And then I realized I'd kind of bit off a little bit more than I chewed. And that, it's not really the kind of thing where you live off the land anymore. You got to dump a lot of capital into a project like that. Mm-hmm. And, it still might be a pet project for my retirement years, but it wasn't really going to work out at the time.
Right. And that was 2008. And you still own that ranch to this day. Is that right?
Yeah, that's correct. I got 132 acres out in Rio Vista, California, if anyone knows where that is.
A lot of responsibility, but I imagine it's also pretty nice too. Okay, and that kind of dovetails with a few passions you have, right? Like you're really big into animal rights, and you're also a vegan, right?
That's correct. Yeah, 100% plant-based for both the health, the environment, and ethically, vegan as well.
Okay. And I imagine you have a few vegan friends up there in NorCal as well.
Just a couple.
Right. Exactly. Okay, so you graduate from Berkeley 2008 and you buy a ranch with your father. Then you decide that professionally, maybe it's not exactly the direction you want to go in. So what direction did you go right after buying the ranch?
Well, it's funny, had always been kind of entrepreneurial, but with that mortgage kind of looming over me, I was really looking for a stable career, steady paychecks, so I could make my payments on time. And I was hitting the job market pretty much like the worst time to be looking for a job. And that's one of the, great things about the insurance industry. We're always hiring. Good economy, bad economy, people need their insurance. Some companies go out of business, some companies don't. My niche of buildings, the buildings don't go anywhere. New ones go up during a good economy, but the old ones are still there in a bad economy, and someone needs to be insuring them. So, and I do think that kind of shaped my entire focus. And I can't say that it was the first thing I settled on when I went into insurance, but over the course of a year or so, I kind of just ended up working into that niche, and the rest is history.
Okay, let's hear about the path about how you got into that niche. So, what was the first job you had in insurance after graduating from Berkeley?
So yeah, I remember it was like '09 or so when I'm looking for jobs, and it was the kind of thing where I thought Berkeley econ, I'm just gonna send a couple of resumes out and they're gonna be lined up begging me to come join them, right? And it was a rude awakening. I remember one job I applied for was for a city economist or budget analyst, something like that, for city of Berkeley. And I took the civil service exam. When I sat for the civil service exam, there was about 6,000 of us that were sitting for about 3 positions that were opening up.
Wow.
And I got the highest marks and everything on the exams, but didn't even get a call to like schedule an interview.
Wow. Maybe you didn't have friends in the right places.
Yeah, exactly. So, it was just sending out apps after apps. And at that time, you were lucky to even get a phone call where they would let you know that they didn't want you. It was just a crazy time. And I got lucky that, one of my dad's friends was kind of doing a mid-career switch himself. He was a successful restaurant owner in Berkeley, and he opened a insurance agency, and I was employee number 3 over there. So I kind of helped him get that started. That was my first job, just kind of taking phone calls, filling out applications, sending out policies. Kind of got my feet wet in a lot of home and auto at that time. But I was doing a little bit of commercial as well. So I kind of got a good taste of everything at that job.
Okay, when you say home and auto, you're referring to home and auto insurance policies, correct?
That's correct, yeah.
Okay, got it. Just a quick side note as well. You mentioned having a rude awakening when you graduated. I graduated UCLA in 2005, as you know. And when I came out, I thought that fantastic jobs were going to be served to me on a silver platter. And I was just shocked coming out. And I remember the first job I was able to get before I went to law school was $13 an hour doing data entry. And that was
And '05 was those are the good old days, man.
Yeah, I guess so. Exactly. And
'09 was like '08, '09. It was just
came out in a tougher period for sure. Yeah,
we're
no
the
doubt.
lost generation.
Yeah, exactly. So anyway, getting back to the story. Okay, so you team up with your dad's buddy, or not team up, but you go to work for your dad's buddy who's making the switch from restaurant to insurance agency.
Yeah, I definitely wasn't a big enough shot to team up at that point. I was just kind of like, I was a step above an intern.
Got it. Okay, so you started off at the bottom, and how long did you work for him, answering telephone calls, sending out policies, and so forth?
So I was there for about a year, just kind of doing whatever it took. And after a year, I found a small boutique firm in San Francisco that was specializing in building owners, and just begged the guy for a job pretty much. That was about 2011, I believe.
Okay.
I started in insurance right around the end of 2010.
Okay.
So the ranch thing took me through about '09, and then I was working for a small solar company until 2010. So insurance, I got into it in 2010, and 2011 is when I switched to San Francisco at the boutique firm specializing in building owners.
Okay. And did you start there doing kind of the same thing, like at the lower level, answering
I actually
telephones?
took a step down because that agency had about 8, 9 people at the time. And the only thing that the owner needed at the time was someone to burn CDs with the policies on them
Okay.
and mail them out. So, I mean, that was like probably a step below data entry, even, right? And I told the guy, I was like, listen, I want to do anything I can to get my foot in the door. Um, and I got a little cocky at that point because I was like, geez Louise, right? I was like, you will be utilizing me for something more than this very soon. I can confidently tell you that, sir, right? And of course, he liked the little pep in my step and he gave me a shot. It's just funny as it worked out. He had a couple personnel shifts, and before 2 weeks was out, I was running the customer service department at that small agency.
Wow. Yeah. That's funny. And sometimes it works out like that. I mean, I guess they say success is where preparation meets luck or opportunity, I guess. And so yeah, that's a good example. Okay, great. So you went to work for that company. That's when you got your introduction to insurance for apartment buildings, correct?
I had done a couple apartment buildings at the other place, but that's where I kind of got the idea that you can focus on one niche and just
Mm,
really know the market inside out. At the other agency, it was more like a Main Street general agency. One week we'd be working on a restaurant, one week we'd be working on an apartment building, one week we'd be working on a contractor. It wasn't until I took the job in San Francisco where it was like every day, all day, we were living and breathing just building owners, to where you get to know the underwriters on a first name basis. And, a lot of magic starts to happen when you just do the same thing in and out.
okay, great. How long did you stay with them?
I was there for 2 years. And like we said, I started out just burning CDs. In 2 weeks, I was heading up the customer service department, fielding service calls, and just putting out fires. A year in, I was promoted to what's called an account manager, where I took over a book and just made sure that the policies renewed every year.
Right.
And then also directed the service staff when they needed to step in and service the existing clients outside of that policy renewal window.
Got it. Got it. And Mike, as you know, I worked 3 years in-house for a large insurance company doing defense, personal injury, and workers' compensation defense. And in my experience with insurance, so much of it is customer service and specifically just getting back to people in time, which seems so obvious and so trite. But so many people don't do it. So many agents don't do it. Would you say that it was at that agency that you kind of, cut your teeth basically on learning the customer service aspect of the insurance industry?
Definitely, definitely. I owe so much to my experience running that customer department. And when you're running it and when you're training other service reps, especially, you start to learn that it's not just about what you're doing, but it's about letting everybody else know who's in on the play. This is what I'm doing. This is when I expect it to be done. Keeping
Right.
them up to date. A lot of times you just think that everyone kind of knows what's going on behind the scenes, and people just need to know that things are being managed.
Right. Great. Okay. So from there, where did you go?
So after 2 years there, I got an interview with Arthur J. Gallagher, which I believe at the time I interviewed, it was the fourth largest insurance brokerage
Hmm.
in the world. And it had since climbed up to number 3. And I think recently it settled back into number 4. But, so it's always a major player there. Um, got an offer with them and did make the switch there.
Okay. Very nice. How long did you work at Arthur J. Gallagher?
I was at Gallagher another 2 years, and I really liked that job in terms of, the largest company I'd worked at that point had been 10 people. So now I'm working at this, multinational, several thousand employees, offices everywhere, and just really seeing how the real, big corporate America kind of fits in.
Right. You saw how it was to work for the man, basically. Right.
Yeah, exactly. With the 401k and all the benefits, and then it's both a structure that kind of gives you some kind of sense of stability, but at the same time, it can kind of stifle creativity. So, it's a double-edged sword, and it works, obviously works for, hundreds and hundreds of thousands of people, or they wouldn't be so successful.
Got it. Got it. So your time at Gallagher was basically your last stop before you struck out on your own and kind of blazed your path creating ABO Insurance, which is your own insurance agency, right?
Actually, as it turned out, my former boss in San Francisco had needed some help. He was kind of taking his agency to new levels, and he wanted someone to come from that big corporate experience and kind of help him kick it into gear.
Mm.
So I did take a special project with him that took about 1 year.
Okay.
And then when we finished that, that's when I came and struck it out on my own.
Okay, got it. Okay, so now you are the owner and president of ABO Insurance. And how long has it been? About 2 years now, Mike?
Just more than, I think right around end of November, beginning of December is when I launched. So we're just past the 2 year mark.
Okay, congratulations on that. That's fantastic.
Yeah, and as you know, for an insurance agency, you start out with zero, and then you're just making commissions. And so much of what we do is relying on renewals. So it really, now that we're 2 years in, I'm just starting to feel a lot more confident. The first year was a huge leap of faith.
Absolutely. I mean, there's a learning curve, obviously, for all businesses, and especially with insurance, like you said, which relies on renewals so much. Real quick before we move on. So somewhere along this path after Berkeley, you went and got your ARM designation, which is Associate in Risk Management.
Oh, right. That's, that was another point I wanted to give 100% kudos to Arthur J. Gallagher.
Mm-hmm.
He had an amazing education initiative where they would give us, they would pay for all our continuing education, and they actually even gave me a bonus to go out and complete that designation.
Mm-hmm.
So that was something that was, an awesome program, an awesome benefit of working at a company like Arthur J. Gallagher, and I took full advantage of it.
That's great. That's great. Now, before we get into substantive information about what people can do when they're looking for insurance policies, I just want to ask you one more question about your interest in insurance. Now, Mike, I've described you talking about insurance like watching a kid open gifts on Christmas morning. And, nothing against insurance. I personally, as you know, I kind of like insurance, but it is looked upon by some people, excluding present company, as maybe being a little bit of a dry subject. So my question is, how did you develop a love for something like insurance?
Slowly but surely, Parviz. Slowly but surely. No, it's an intersection of so many different fields of knowledge. I mean, you got to be somewhat proficient in law. You have to know how to read contracts. You have to know how to read an insurance document, which is just a huge contract. And at the same time, there's economics. You have to know how prices are, how policies are priced. You have to follow how the markets shift and change. And a lot of sales, so a lot of person-to-person, developing your speaking skills, developing rapport with people. So I kind of I kind of fell in love with insurance as this intersection of all these different human endeavors that I'd kind of been passionate about, and how they all kind of play against each other.
Okay, very nice. Okay, so a little bit later in the interview, I'm going to circle back around and talk about exactly what you focus on in ABO Insurance. But I'm itching to get into some substantive questions about what people can look for and what they need to watch out for when they're looking for auto policies, homeowner policies, and building owners, basically building policies. Okay. So I'm going to jump right into it, Mike. Somebody's looking for an auto policy. In California, we're not known for having great public transportation, especially
not yet.
Exactly. Yeah, not yet, especially in Southern California where I live. So people drive cars, and if you have a car, you need to have an auto policy, auto insurance policy by law. What are the top mistakes that people make, and maybe some mistakes that are not obvious when they're searching for an auto insurance policy?
Well, it's a double-edged sword that California requires auto insurance, because if the state has a minimum requirement, a lot of people can confuse that as an endorsement, as like this is a sufficient amount of insurance to have.
Right.
But when you look at the statutory minimum insurance in California, it's $15,000 per accident. Um, I mean, you've handled some claims. I believe I don't even sell state minimum policies. I refuse to even sell the absolute minimum.
Mm-hmm.
People want to do that, they can talk to, pick up the phone book and talk to some of those, specialist carriers for auto insurance. So I can't even remember what the property minimum is. I believe it's 10,000 or something.
10,000. Correct.
10,000. Okay. So 15, 30, 10 split limit. I mean, you can nick the fender of a BMW and spend more than that.
Correct. And just to clarify for our viewers here, when you say 15, 30, 10 split limit, what we're saying is $15,000 limit per person injured in the accident, 30,000 total per accident,
Correct.
and 10,000 in property damage in the accident.
Correct.
Okay. So what that means, and I can speak kind of competently, well, I can speak competently to this because, as I mentioned, I did do insurance defense for 3 years. And you see accidents where, like you said, there is a fender bender, okay, and somebody can be certainly claiming more than $15,000 in medical bills and possibly getting more than 15,000, whether it be in a settlement or a trial. It's a tiny limit. I mean, we're not talking about any type of substantive accident at all. I mean, if you hit somebody going 20, 30 miles an hour, even 15 miles per hour, you're likely going to end up coming out of pocket in any type of settlement or trial if it's your fault, because a $15,000 limit per person and 30,000 limit per accident is just tiny in California. California is super litigious, as you know as well. So basically, I'm understanding you, Mike.
And that's a conversation that I just don't want to have with the client. So I have it up front that, like, listen, we're going to start with maybe 100, 300, and maybe 25,000 per property. That's kind of about the minimum that I would go.
Right.
I mean, just to even start the conversation, because I don't want to have a conversation with someone that has minimum limits and, God forbid, they've hurt someone and now they're wondering what's going to happen. It's just, I don't want to be there. Right. So I'd say that's the number one mistake that I see. And it's especially ironic when you see, someone who maybe got a policy when they were a college student or something like that. And then now they're 10 years into their career, they're super successful, and they still have that minimum liability limit. And a lot of times you'll see them with really low liability limits, but they have comp and collision coverage. So I'm like, you're covering the $30,000 risk, let's say, that you have, that is your car, and you're worried about something happening to that, but you're not covering the $300,000 liability that you have out there, which is all the other people out there that you could cause damages.
Right.
To me, that's just completely backwards. And I wanted to emphasize that, liability is generally much cheaper to insure than property.
Okay.
So why are you paying top dollar? Sorry?
You said a lot of things here. Let's just pause for a second so we can unpack a little bit of what you said, and we'll allow you to continue. So first of all, you mentioned comp and collision coverage. Everybody listening to this video might not know exactly what you're referring to when you say that. So if I understood correctly, you said that you'll see somebody come in, they have a policy that has policy minimums, the 1530 policy that we mentioned, okay, 15,000 per person, 30,000 per accident, but yet they'll have comp and collision coverage. What is comp and collision coverage, Mike?
So you have two types of property coverage that covers the vehicle that you own. The first is collision coverage, which covers your vehicle while it's moving, while someone's operating it. And then you have comp coverage, which you can think of as everything else. When you're not driving the car, all the things that could happen to it. It could get stolen, a tree could fall on it, what have you. The only exception to that rule is if you hit a wild animal, that will also be covered under comp. It's considered not your fault. You can't control when a deer jumps out in the road. But other than that, you should think of collision as anything that happens while the vehicle is moving, and comp is everything else.
Okay, got it. So let's continue on forward. So why does it not make sense for somebody to have minimum policy limits, but also have comp and collision coverage?
It's kind of like you're more concerned with the value of your car, which is way lower than all the liability that you could cause in an accident. Right. I can control the value of my car to a certain extent, but I can't control what the value of the car is that I'm going to hit, or how much damages that individual is going to suffer in medical and missed work and all that kind of stuff.
Right.
So, and the other thing is like, I think we looked at yours, Parviz, and doubling or tripling your liability limits might only be another 100, 150, $200 a year, let's say, whereas your comp coverage could be costing you, $500, $600 a year. So it's just funny that you're spending more to protect something smaller when you're not doing the minimum first step, which is selecting an appropriate liability limit.
Right. Okay. So just to give an example, if somebody is a big baller, they drive a Mercedes, $80,000 Mercedes, let's say, okay, an expensive car for most people, right? They could get into an accident, and their collision coverage could cover their Mercedes for up to $80,000, right? But by contrast, or not contrast, but by comparison, they could injure somebody tragically in a way that basically causes liability for their bodily injury in the millions of dollars. Is that correct?
Correct.
Okay, so that's what you mean when you say basically that you can control and kind of limit the liability for collision.
I think it's like people see their car, so they're worried about like, oh my gosh, if something happens, can I afford to replace it? So you kind of have a fear of the things that you've seen, and you kind of put blinders on for all the things that you don't see.
Right.
But what's going to put most people out of business, what's going to really affect someone's life and force them to continue in a way that's entirely different than the lifestyle that they're living now, is racking up a huge liability bill.
Okay, great. Okay, so that's one big mistake, is that you see people skimp on policy limits. The second mistake related to that is that you see people come in with small policy limits, but comp and collision coverage. What's another big mistake that you see people make?
Yeah, I wanted to add there, Parviz, too, like if it's a budget issue, people could bump up their deductibles and then use that money to pay for a little bit of extra liability. So it's not always spend more. Sometimes it's just allocate your money more smartly.
Okay. Very nice. Got it. Okay, so let's move on then, I guess. What is another thing that people need to look out for, a mistake to avoid when shopping for an auto policy, and something that would protect them?
Life updates. I would say, not updating your broker or insurance company after major life events. I think a lot of people think of insurance as this kind of static thing, and it's very much like I have insurance or I don't have insurance. But your insurance is only as good as the information is up to date. So, when you get married, let us know that you got married. Maybe we need to list your wife on the auto policy. Being married lowers your rates, so you might as well be telling us that.
Okay.
Updating your policy limits as you develop throughout your career. When you're a successful attorney, you probably need a little bit more liability than when you were a law student.
Okay. So, Mikey, do people that get married behave in a less risky way? Is that it?
I believe that's what the actuarial data would support.
Okay. Interesting. Very interesting. Okay, so updating information after major life events. Realistically, somebody's going to see their policy price go down significantly because they got married.
Well, it's going to be both that you're getting older and you're getting more experience, and yes, being married will lower the rate. It's going to vary from company to company based on what their actuarial data says for your area.
Okay.
But it will go down.
Okay. How often should somebody basically take a look at their insurance information to see if any updates are needed? People are busy, they're running around, sometimes people don't even have the time to call mom or dad and say hi. How often should they sit down and do a review of their insurance information?
I like to encourage people at a minimum to give it 10, 20 minutes of thought every time that their policy renews.
Okay.
And then also, outside of the policy renewals, let major life events trigger you to review your documents with your broker. Am I getting married? Am I starting a business? Am I, getting a huge promotion at my job? All of these kind of things are areas where it's like, you're probably no longer at that optimal balance between what your budget is and what the best coverage is, right? Either you have a little bit more money to spend and you want to bump your limits up, or you want to start reallocating. When you're a little bit more successful, you probably have a little bit more cash on hand. So some coverages I'm okay with decreasing, like the deductibles. Let's raise those deductibles because you're probably able to cover $1,000 when you were in college. You might have only been able to cover 250.
Right.
And let's raise those deductibles to 1,000, and at the same time let's raise those liability limits because now you've got a lot more to lose. You become more of a target. If I get rear-ended by a college kid, there's a little bit less of an incentive for me to all of a sudden notice that I have all these medical problems than if I get rear-ended by a successful attorney.
Of course, yeah, absolutely. So, Mike, before I met you,
hopefully none of us think that way. Hopefully none of Parviz's listeners think that way, but it's just a sad reality that a lot of people do think that way out there.
Yeah, it's absolutely right. I mean, there's great people walking around, and there's people who take advantage, and everything in between. So, your job and our job is to protect ourselves as much as possible. Makes sense. So, Mike, a lot of people in my opinion, don't really talk to their insurance brokers. I know for me, until a few years ago, I would never call an insurance broker to discuss a life change or anything related to my policy. Is that something that people should feel free to do with their brokers? Basically pick up the phone and call them and say, hey, this happened, that happened. Should we update my policy? Should we go over, the possibility of having new terms and so forth?
Yeah, I mean, anybody should do that. Even if you don't have a broker, you can pick up the phone and talk to an associate at any of these major insurance carriers. They're obviously going to be a little bit less interested in giving you the best possible experience because they're just, it's boiler room over there. But if you've hired a broker, that's what your broker's job is. So you should have a good rapport with your broker. And if you don't, you should find someone that you do have a good rapport with.
Okay, great. Do you field a lot of calls from your clients?
I mean, the approach that I take is very hands-on. So, I'm sometimes reviewing policies that my clients have with other direct companies. Because when I bring someone on with home and auto, it's really just a service that I'm adding to my existing clientele that are bringing in the business that I'm focused on, which is buildings. So I have building owners, and there's plenty of times when I'm like, you know what? Let's keep you with Geico for now. I don't think we're going to do better than this. But at the same time, I'm happy to review your Geico policy with you.
Okay, great. All right. Moving on, Mike, I want to ask you about something that comes up sometimes, and I certainly saw it when I worked in-house for that insurance company, which is the issue of listing all drivers in the household on an insurance policy.
Right.
So I'm going to repeat that again. The issue of listing all drivers in the household on the insurance policy. Why does this matter, Mike?
So there's a little bit of confusion because people think like, as long as I have insurance, anyone who drives my car is covered. And there is some truth to that. Like, I don't have to list every single person who could ever potentially drive my car. I might not even know who that's going to be until, I meet a buddy this week and I want to let them drive my car. But when someone lives in your household with you, if you are going to give them access to your vehicle, it's a condition of the policy that person should be listed. And as I'm sure you've seen on the claim side, what can happen when you don't go through that. And if you really have someone who's problematic in your household, who's just a horrible driver and is going to, shoot your rate through the roof, you can choose to exclude them on the policy, but they're explicitly listed on your policy as an excluded driver. And then when you do that, you're crossing your heart and pinky swearing to the insurance underwriters that person will not get behind your wheel.
Right.
Obviously, if that person is excluded and something does happen, there's not going to be coverage. So, that's the way to get around it if you did have a problematic driver in your household. But you got to play fair with the underwriters.
Okay, great. So, for example, if I'm living in Koreatown by myself in an apartment, I get an insurance policy. Anybody else in my life is covered by my insurance policy if I give them consent to drive my car, correct?
Correct. With the caveat that regular drivers, especially if you have a roommate in your household, it doesn't have to be a family member, but if someone lives under the same roof as you, that's just seen as having way more likely to be having access to your vehicle.
Right.
That's a person if it's anything more than a one-off kind of a situation, you're going to really want to have that person listed on your policy.
Absolutely. So in using the same example, if my sister comes to live with me, okay, the moment that she comes to live with me, that insurance policy no longer covers her unless I get her specifically added to the policy.
That's the best practice. There might be some gray area there, depending on what company you're working with. But
Right.
the best practice is anyone living under the same roof as you should be listed, because there
Okay.
are going to be occasions when claims will be denied.
Okay. Okay. Great. Um, okay. Anything else that you want to mention to to listeners about the issue of listing drivers properly or the proper drivers on your policy?
Garaging address. I think a lot of people don't realize that the zip code of your garaging address is one of the largest factors in determining rates. They get their actuarial data by zip code. And some zip codes are going to have more accidents than others, so they're going to charge more in those zip codes. So you do want to make sure that you're rating under the correct garaging address. Sometimes people have multiple homes or an office. If a car stays at your office, it's garage at that office. It's not garage at your home. So I see some mistakes in that. The other big mistake I see is, kind of blurring the line between your business policy and your personal policy.
Mm-hmm.
So for some of us, it's a gray area. Like as an insurance broker, I do own my vehicle as an individual, and I have a personal policy on it with a business use endorsement. And that's the appropriate way to do it when you do own the vehicle personally, but do use it for business.
Okay.
Now, the converse of that, I see a lot of people that own their vehicle. The company owns their car. They have some kind of a S corp or an LLC set up. They purchase the vehicle through that, to take advantage of all the deductions and things that they can, and then they just slap that onto their personal policy. And in that case, it's completely unambiguous. You need a commercial auto policy to cover that vehicle.
Okay. Okay. Got it. So people need to be really careful about what type of policy they're getting for the vehicle, and obviously that it's under the right name, correct? Because if you have a business, even if the business is named after you, that it's a different entity, correct?
Correct. Yeah. And if I wanted to take if I wanted to maximize all the business deductions that I would make on my car, and I wanted to really make that my company car, then I should have my company own that vehicle. Okay. So I see the mistake go in both directions. I see a lot of times the company should own their car and it doesn't, and then I see times where the company owns their car and it's on a policy that's inappropriate for that. So
got it. Okay. As a segue to our next topic, which is going to be homeowners policies, I'm going to just ask you straight up: if somebody is a homeowner and a vehicle owner, they need insurance for both, is it usually beneficial to try to shop for a combined auto and homeowners insurance policy?
I could see market conditionings changing, so I'm hesitant to say it's always the best, but it's always the place that you start with, because there are significant discounts for bundling together. Okay. I see it range from 20 to 30% off on your auto when you bundle having a renter's policy or a homeowner's policy with that. So it's definitely the starting point. Okay. Especially if you have homeowners tends to be much cheaper. And renters is absolutely the cheapest. So it's going to almost always make sense to bundle a renter's policy with your auto policy, because that policy, it's not going to fluctuate that much difference in price. If I go to a more expensive company, it might be like $50 more. And you should save more than that on the discount that you get on your auto.
Okay. When you say $50 more, you're saying per year?
Correct.
Okay, per year. Got it. Okay, great.
So on a home, if I have a very, very fancy home and there's great fluctuations between different offers that I'm getting, I could see a time where we kind of split the two out. But I would say that the smaller the homeowner policy gets, the more it becomes almost a no-brainer to bundle. And sometimes even with the larger one, it still is a no-brainer to bundle. I'm just trying to think of, what kind of scenario would happen where it doesn't make sense.
Okay, so if I'm understanding you correctly, it probably makes sense to get them together, but it almost always makes sense to start looking for the policies through the lens of possibly bundling. Is that correct?
Correct. Yeah. So you look for a bundle, and then if you find a one-off carrier who's like maybe not offering you any auto coverage, or just has an auto coverage that's way out of reasonable, but they're coming in super aggressive on the homeowner policy, then you can kind of think about splitting them up. But that's the exception to the rule. Generally, we're bundling.
Okay, great. Okay, so let's move on to discussion about homeowners insurance policies. So what are the top 3 things? Well, actually, let's let's back up for a second. What's one big thing that people need to look out for when they're shopping for homeowners insurance policy?
I would say like the biggest elephant in the room is going to be just understanding building replacement limits.
Okay.
So a lot of people get hung up on, well, I bought my home for this, or my neighbor's home just sold and it's only this, and they think that the market value of their home has something to do with what the policy limit should be.
Mm-hmm.
And it's just important to take that step back and think, what does the insurance cover? Does the insurance cover the market price of my home? No, the insurance covers the cost to rebuild in kind if something, God forbid, was to completely destroy my home. So we're looking about, construction replacement costs to replace a building. And that's subject to market forces, but it's subject to the market price of construction, and that's not always even remotely pegged to what the existing. And some people think, okay, so the replacement cost is always less than market value because market value includes land, and that's one way of thinking about it. But in crazy economies where the supply was too high, I have seen the cost of homes fall below what it costs to build them.
Okay.
So in my mind, the best thing you can do is just to completely divorce the two concepts from each other and just don't even think about market value. Just think about cost per square foot construction and what would it take to rebuild my home in the unfortunate case of a total loss.
Okay, got it. So just to back up for a minute and give it context, the number we're talking about is relevant because we're talking about the amount of which you should insure your home for, correct?
Correct.
Okay.
And that's going to be the primary driver of your home insurance cost, is going to be that replacement cost limit that you set for your home.
Got it. So when somebody is determining how much they should insure their home for, they shouldn't be thinking of real estate agents and market listings, but they should be thinking about the cost of lumber, the cost of nails, the cost of construction labor, things like that, right?
Exactly. And this became such a huge problem in the state of California when I was in my first or second year in insurance. So it was either maybe around 2011 that the state actually made us take courses to be able to continue to sell these types of policies. We had to take a course like, how do you value a home? So your insurance agent should be able to sit you down and run through some what's called replacement cost estimators. Marshall and Swift is the proprietary one that's the most famous, but there's a few of them out there. And we can kind of run through, do you have marble kitchens? Do you have custom bathrooms? Do you have designer bathrooms? Or do you have builder grade kitchens and bathrooms? Square footage, we can run through and kind of come down to a pretty basic understanding of what it should cost to replace your building. But the absolute best practice, if you really wanted to get the most accurate dollar amount, would be to have a contractor come in and really do an appraisal of your home and give you a bid on what it would cost to replace it.
Got it. So, Mike, as you know, about 3-4 weeks ago, we had some of the worst wildfires that we've ever had in the state of California. We had them both in Northern California as well as Southern California in the town of Paradise, Calabasas region, and so forth. For somebody who's unfortunate enough to have their entire home burnt down, they wouldn't be looking at their neighbor's home to determine how much the neighbor's home is worth for basically replacing their own home. It would be basically, what is it going to take from the ground up to rebuild this home, correct?
Correct. Yeah, we don't care what the market price of a lot and a home and everything existing in Calabasas is. I just care, what does it cost to get a contractor in Calabasas or to come to Calabasas and to rebuild that home in as close like in quality as your previous home was.
Okay, very interesting. Before we move on, what is a builder's grade kitchen?
Well, we'd be talking about, linoleum flooring and, maybe like that hard pressed particle board with a little bit of a waterproof layering on top, the kind of thing that you would see in a basic apartment.
Got it. Okay. So not a desirable kitchen when you say builder's grade.
Hey, could be desirable to a lot of people, but it's not. You're not going to see it on a $1 million listing.
Got it. Okay, very diplomatic answer. Okay, so Moving on. So one thing that I know you've told me before this interview that is a very important issue is making sure that the right entity is covered when you're getting homeowners insurance. Is that correct?
Correct. And I see, a lot of people might change things. Maybe they put their home into a trust or whatever have you. But they keep things old, or they just start out from the beginning, just putting an individual name on there when it might have always been, owned by an LLC or a trust or something like that. So it's important. You want to think back to the deed, the property deed. Whatever entity is showing up on that deed should probably be reflected on your policy.
Okay, so let me give you an example. Let's say I own a property. Okay, I'm a lawyer, so I decide I want to move it into a trust. Let's say I have owner's insurance on the property with myself listed as the owner. And then I move it into the trust. What do I have to do as to be covered continue to be covered with homeowners insurance?
You should call the company that you wrote it with or the broker that you're working through and just let them know about the new entity. Okay. And I see a lot of people worried because the homeowner's policy covers more than just your home. As I'm sure you're aware, it also covers your personal liabilities. So a lot of people worry about like, oh, now that I'm listing the trust, am I no longer covered? And you want to look into your policy's definitions of who is an insured. There literally will be a part of the policy that says who is insured ? And we'll define it out. And almost always, managing members of the LLC and trustees of the trust are also individually protected. Okay. So as long as the trust is listed, everybody should be okay. And if it was something that you're really, really worried about, you could have a lawyer review that contract for you. But it's usually spelled out very clearly.
Okay, very nice. So in that situation, whether you're transferring a home from an individual to a trust or a trust to an individual, basically you have to make sure that you call the broker up and make sure that the ownership in the policy is changed to the right entity. Is that right? Correct.
Because what's going to happen if, God forbid something happens, you have a house party and someone comes and slips and falls and hurts themselves and they get their lawyers involved. They're going to do their due diligence. They're going to dig into the property deeds and figure out who owns it. And that's the entity that's going to get sued in the lawsuit. And, if I'm suing, the trust and the trust doesn't show up anywhere in the policy, there might not be anything in that contract that triggers coverage. So you're going to definitely want to make sure that all the property entities are covered.
Right. And if no coverage is triggered, that basically means that you could be out there on your own defending a lawsuit for $300,000 or $400,000, $500,000, no insurance, no nothing. Is that correct?
That's correct. Yeah. Under the worst case condition, sometimes especially if you're working with a larger company, admitted market, like your former employer, Liberty Mutual, Travelers, these type of companies, they try to use as broad a language as possible. I know a lot of people think that they're always trying to sneak out of claims, but that's the kind of claim that's going to hurt them more reputationally than they're going to benefit from not paying. Mm. So they try to, draw these definitions as broadly as possible, but that's just not the path that you want to be walking down.
Right.
Where you're fishing and hoping and praying for coverage.
Oh, absolutely. No, we don't want to be there. That's for sure. Okay, let's talk about something that I think there's a lot of people that are very confused about, which is what the heck is covered by homeowners insurance?
Okay, so the most obvious, and a lot of people maybe from a generation above us even refer to these policies as fire insurance. And so that's the most obvious. I mean, you're not going to find a policy that doesn't cover fire. Fire, lightning, all of those types of catastrophic losses to the property, with the exception of earthquake and flood. Those are going to be the two largest excluded disasters that are not covered on a typical homeowners policy. But what people don't realize is that policy also comes with liability. So it's not just a property coverage. There's also liability on there. And that comes with personal liability. I mean, people could use these policies as a recourse for slander and libel. And that's not something that you really think of when it comes to a home. It almost has nothing to do with your home. But personal liability is also tied to these policies. And that's an important reason why, I tell a lot of clients if they don't own a home, they should at least have a renter's policy. And they say, oh, well, I don't have that much stuff. Well, it's like you still have personal liability, right?
Right. Okay, so when you say personal liability, let's take an example. So does that mean basically, you're hosting bridge night at your house, and let's say grandmom's friends all came over, a bunch of 70-year-old ladies. They're sitting around a card table playing bridge. One of them gets up, she trips on the way to the bathroom, breaks her hip, $200,000 in medical bills. Is that a type of personal liability that would generally be covered by homeowners insurance?
They're going to have to look at the incident and determine if it was up to the homeowner's negligence that that trip occurred. And ultimately, if a court finds that it was the homeowner's negligence that directly led to that slip and fall, then yes, that will trigger your homeowner's policy to cover that.
Okay, so that's a big deal, right? Okay, and then you mentioned a moment ago libel and slander, which is something I found really interesting. So, libel, of course, is just the written version of slander, which is basically, an attack on somebody's reputation. So, are you telling me, Mike, that if you have homeowners insurance and you slander somebody, you basically, say that they're dishonest or that they're poor in their profession, or I believe the common law definition includes saying that an unmarried woman is not chaste. I believe that is part of the common law definition of slander. Are you saying that if you,
of course, none of your listeners would ever say those kind of things.
Of course they wouldn't, but if they were accused of doing so, are you saying a homeowner's insurance policy could cover your liability for that?
Now, I've seen plenty of homeowners insurances that are more watered down, and when we go surplus lines, hard to insure homes, it could be excluded. But on a standard policy, that would be something that is included.
Possibly, it could be included, something like that.
Yeah, that is something that is possibly included.
Okay, very interesting. What are some other things that are sometimes or oftentimes covered by homeowners insurance policies that people don't tend to think of or know about?
One of the most common things that you see is dog bites, and it is a sensitive topic for insurance companies. So I'm sure some of my underwriters out there, if they're watching this video, they're wincing a little bit that I'm even mentioning it. Yep. So if you do own a dog, I would recommend that you review that with your broker or the insurance company. I typically don't see it excluded unless you have a dangerous breed. Pit bulls, Rottweilers, those tend to come up. Those are going to be hard to find coverage for. Right. But your Chihuahuas and your Poodles should typically be covered.
How about a German Shepherd?
Now you're just trying to find these gray areas.
Yeah. It's funny you actually mentioned dog bites, because I actually dealt with a few dog bites as well for the insurance company. And I don't believe I came across a policy that excluded any breeds other than pit bulls. I believe, and of course, everybody's situation is different. They need to look into it. But just speaking of my experience, I think almost all the policies, if not all the ones I saw, just excluded pit bulls.
Pit bulls is pretty universal. Yes. You're going to see that excluded. And you probably looked at a lot more of those because you dealt with claims. You dealt with a lot more claims than I have, just being that was your career for all those years. I have seen Rottweilers listed on some of the apartment building policies that I have, but you're right. Looking back, I'm not sure if I've seen it on a homeowner's policy.
Okay, got it. And nothing against pit bulls. We love all dogs, all right? But
exactly.
Apparently, insurance companies have some, concerns about them. What about liquor liability for homeowners? What is that?
That's something that you're going to want to look into and make sure that your policy covers. The state of California can hold an individual liable if they knowingly allowed someone to get drunk on their premise and then allowed them to drive off the property. So there's some states that are worse than California, believe it or not, for that. But you could be held liable for that in the state of California.
Okay, so let's say I'm 25 years old, which I'm not, but I'm 25, I have a house, I own homeowners insurance, and I throw a party, a raging party. I have a ton of people over, and I'm serving out liquor and shots like there's going to be a prohibition tomorrow, okay? And somebody gets drunk at my party, they drive off at 2 or 3 a.m., and boom, the first intersection that they're at, they get into an accident and they injure somebody. I could possibly be held liable for that person injuring
Correct.
somebody in a
The
DUI.
standard to hold a homeowner liable for that case is much higher, and you're a lawyer, so you could dig into that and get the actual, details. I don't know exactly where the cutoff is, but I do know that the standard is much higher than if you were, say, a bar owner or an establishment whose business it was to serve alcohol.
Mm-hmm.
At the same time, it is something that you want to keep in mind even as a homeowner.
Right, exactly. So what you're referring to there basically is that if I, as the party owner, see this person stumbling around completely drunk, it's obvious that they can barely stand up, and I say, here, take another drink. And then 2 minutes later, I see them walk out to their car and say, hey, great, good luck. I hope you make it home in one piece.
And God forbid you took a video and posted it to social media.
Yeah, exactly. So that's kind of, I think, what you're referring to, right? When you say basically, failing a standard of care as a homeowner.
Exactly. Yeah. There's a much, you have to be much more blatantly, contributing as a homeowner to be in trouble for that kind of a thing than what you would have to do as a bar owner to get in trouble for that kind of thing. But, the liability is still there. So it's something to think about. Absolutely.
Okay, that makes sense. So before we move on to just one or two other items that people might not know are included in insurance policies, what does somebody have to do when they're getting a homeowner's insurance policy to try to make sure that they get as many of these inclusions as possible so that they're covered from as many angles as possible?
It's good to work with someone who's going to go through all the questions with you. I mean, have you told the insurance company that you have a swimming pool? Did you know that swimming pools is one of the biggest liabilities that you can have? And if there's going to be small children around, or if there's any way for small children that are not even guests of yours, but if there's any way that they could sneak onto your property, are you doing everything you can to secure the property? Do you have fences all around the pool? Are they self-locking? Is it the kind of thing where it's practically impossible for someone to even hold the door open because it just automatically swings shut on its own? Right. Or does it stay open? These are all things that we have to look into. And a lot of times when you sign for your policy, you may have signed that is the case when it's not, and that could be, an excuse for coverage to get denied.
Okay, so when somebody's shopping for one of these policies, and let's say they want to really, do things by the book and cover themselves, they need to tell their broker, hey, I have a pool, I have a dog, I have parties sometimes, people, come over. I want as many of these inclusions as possible. It's something they should communicate to their broker, right?
Definitely. I mean, in a perfect world, your broker should be holding your hand and going over all these things with you. But, as we all know, some people are going to be cutting some corners, and you definitely want to be making sure that you're being forthright. And then don't sign anything without reading it and making sure that, because when you purchase a policy, you are basically signing that everything that we reported to the carrier is what you know to the best of your knowledge. So, make sure that there's nothing on there that's obviously incorrect that you were aware of.
So, Mike, are you saying that somebody should sit down with their
God forbid, right?
100-page policy that they're going to sign? It's a contract, potentially dealing with tens of thousands or hundreds of thousands of dollars, and they have to actually read the darn thing? Is that what you're saying?
In a perfect world, yes. In the real world, is that going to happen? Probably not. You're probably not going to sit down and read the entire 50-page or 100-page document that you have. But at a minimum, you can read the application that you submitted to the insurance carrier and review all the answers that you gave and make sure that all the answers that you did give were the best answers that you could give with all the available information that you had at the time.
Okay, very good. Let's say somebody, they would like to read the whole darn thing, but it's confusing, it's long, they're busy. In addition to reading the application that they submit to the insurance company to make sure the information they give is accurate, would you say that reading the exclusions portion of the policy is one of the other really important things to read?
I mean, I drill that into my commercial clients all the time. That's the first thing you want to look at. You start with the exclusions and do they make sense?
Okay, got it.
If I have a swimming pool, for example, I definitely don't want to see that, swimming pools are excluded on my policy.
Got it. Let's go over that for a moment. And we'll get to commercial policies in a moment. But why is it dangerous to have a swimming pool according to insurance companies?
There's more of it's going to be a sensitive topic because every year children do drown in swimming pools. And people that have to emotionally go through that, there's going to be fingers pointed. It's just natural that people are going to want to dig around and see who was at fault for that, and that's going to be something that leads to lawsuits.
Okay.
So,
Okay. Let's. Sorry. Go ahead.
And we know the standard there for a homeowner's policy to coverage to trigger is the negligence, and that's just something that's so easy to say. If you had been a little bit more careful to make sure that the gate around the swimming pool was self-locking, this might not have happened to my child.
Right. So by self-locking, what you mean basically is that if the gate opens, it automatically closes by itself without somebody pushing it shut, and it locks on its own without somebody twisting anything or pushing anything.
That's correct.
Okay, got it. Let's say I have a swimming pool, but there's no water in my swimming pool. Nobody swims in my swimming pool, so no kids are going to drown. Is it still dangerous according to insurance companies?
Well, in Southern California, we actually see that a lot, right? I mean, you have the empty swimming pools, and then Tyler comes over with all his friends and turns it into a skate park, right? So I'd say it's still a liability for you. It's probably going to be a little bit different than swimming pool coverage, but you still have kids that could break their arms back there, and it's
absolutely. And actually, I was kind of asking that question tongue in cheek. When I was working at the insurance company, we saw many times somebody fall in, especially at night, to an empty swimming pool. Either they were not looking where they were going, or they slipped. And I remember one case in particular, a guy slipped, cracked his head, brain damage, and there was a lawsuit on the table for $7 million. Completely empty swimming pool. So swimming pools, in my opinion, and I think you would agree, are dangerous as far as from an actuarial standpoint, whether filled with water or not filled with water, because either way, somebody can get injured seriously with them, right?
The only other thing I see that's like as much of a sore thumb for my insurance underwriters is trampolines. Trampolines are almost universally will cause them to get off a policy if they see those things. I mean,
I remember
trampolines are just a trap for injuries.
No, absolutely. I remember when I was a kid and growing up in Glenside, Pennsylvania, and one of the kids on my street had a huge trampoline, and we used to launch each other into the air. Okay. And I look back on that and I think to myself, it's a miracle that I did not break at least several bones while on that trampoline.
Yeah, growing up, I mean, I've had several friends that at least sprained an ankle or broke an arm on a trampoline. It's just
yeah. No, absolutely. Okay, so we got personal liability, fire, swimming pools, dog bites. Anything else that you think is kind of something that people need to know when they're shopping for homeowners insurance that they might not know to look out for?
Yeah, I like to ask all of my clients, do you have any, pseudo employees that show up to the property, whether that's a babysitter, a gardener, a part-time chef, whatever you have bringing into your home. If they don't really own their own business and have their own insurance coverage, you could be on the hook for their workers' comp. And a lot of policies, it's just an extra endorsement that we can endorse right onto the policy, incidental worker comp coverage for any, servants or staff that you have at the home. And that's always something that, it's worth us looking at, but you have to ask. It's generally not just automatically thrown on the policy.
Got it. So let me back up for a second and unpack a few things and specifically terms that you just mentioned right now. So first of all, you referred to workers' compensation, and by that, what you mean is that tell me if I'm correct. Somebody comes, let's say grandma's back in the picture again. Same grandma. Grandma's needs a caretaker, part-time. She comes in, she takes care of grandma for 5 or 6 hours of the day. And let's say she gets injured at the home taking care of grandma. Now, that's something that would potentially have to be covered by a workers' compensation claim, which is basically covers people who get injured while working as an employee. Is that correct?
And the important thing to remember there, especially people who aren't small business owners, they might not know this. The liability standard there is completely different than for a guest who comes into your home and slips and falls.
Absolutely.
When a guest comes into your home and slips and falls, for you to be held liable for that, there has to be some kind of a negligence, some kind of a negligent act.
Correct.
Workers' compensation is a no-fault coverage.
Right.
The only thing that the individual has to prove is that they did sustain an injury, and they did sustain that injury while they were working.
That's correct.
And then, and in that case, the employer is on the hook no matter what, whether it was the employer's negligence or not. So, in the case where there is no clear-cut employer covering that worker, who are they going to come after? They're going to come after the person who was paying them.
Absolutely. And I just want to add here myself, for any people that are thinking to themselves, well, that caretaker that comes over she's not an employee. I just pay her, $200 a day or $200 a week or something like that. We don't have any contract. That's just simply not true. Okay, that person could still, that type of characterization that you try to place on the interaction between you and the injured party does not matter. They could still be considered, and in that situation, likely still would be considered to be an employee for the purposes of whether they are covered by workers' compensation if they get injured on the job. So I hope I'm not getting too technical with that jargon, but basically what that means is that in many states, and particularly in California, a lot of people are doing work for other people that are technically classified as employees. And if they're classified as employees and they get injured while doing that work, even if you don't think they're your employee, you could be liable for a workers' compensation claim, which we would want to be covered by a homeowner's insurance policy. As
Correct. And the only caveat I would have there is, like, if you just for some reason really don't want to be liable for that, and you don't want to get your own policy, at least make sure the people that you're working with are truly independent contractors. Maybe if it's a gardener, they even have their own license. Right. They're carrying their own workers' comp coverage. They can give you a certificate that shows their workers' comp coverage and lists you as a certificate holder, and you collect that from them every year to make sure that they have, as long as there's a worker comp policy there that the injured employee can point to, you'll be safe. But it's when there's no workers' comp coverage in place. California defines employee loosely enough to try to help all these people that are getting injured. So when someone gets injured, we will find someone to point a finger at if we don't have one already defined clearly.
That's absolutely right. I think that's an excellent point, trying to assure that anybody who's working in or around your home has their own workers' compensation policy. One thing I'll add is that this concept that we're talking about applies even more so if anybody's doing any type of construction related to your home. That is super duper important to make sure that either they have workers' compensation coverage, or that you're providing them that in some way, shape, or form. And obviously, construction is an area that has a very high risk and occurrence of injury and severity of injury, because building stuff hurts people. That's just the way it works, right?
100%.
Absolutely. Okay, great. Anything else you want to mention about homeowners policies before we go on to before we go into buildings and apartment owners that?
No, yeah, I think we hit everything that we set out to talk about today.
Okay, great. So should we move on
to? One last thing too. When we talked about letting us know when you got married, let's say you own the home as an individual, and so you'd only listed yourself on the policy. Your home is still protected, but because of that personal liability, it'd be nice to add your spouse so that their personal liability could get triggered as well on that policy. So there's just one last thing to talk about. When you do get married, are both spouses covered on the policy? Make sure that you would add them.
Absolutely. Shall we talk about building and apartment owners?
Yeah, I've been waited with bated breath for this moment, Parviz.
Okay, great. I know this is an area you're super passionate about. So I'll kick it off. What is a big mistake or something that is very important for people to look out for owners of buildings, and especially apartment buildings, when they're looking for insurance policies?
So the number one driver of building insurance costs is going to be, again, our old familiar friend, the replacement cost. Only now there's a lot more landmines for us to navigate against, because these policies are going to be much more restrictive than a homeowner policy. A lot of homeowner policies, just to avoid problems with so many people being underinsured, they've built in 50% extended replacement cost endorsements, And there's so many throw-ins that to protect you from underinsuring yourself. And you're not going to necessarily have those safeguards with a commercial building owner's policy. And remember, you're on commercial when it's any kind of retail space is involved, any type of commercial space is involved, or if you have 5 or more residential units, that's going to be considered a commercial policy.
Okay.
And some of these policies even have co-insurance penalties where you get penalized for underinsuring. So let's say they had a 100% co-insurance penalty. If you have $1 million building that you're only covering for $500,000 and you have a $100,000 loss, a lot of people think, I'm covered. I had a $500,000 limit. I only had a $100,000 loss. But because you're only insuring the building 50% to value, 100% co-insurance penalty could cause the policy to only pay 50% of the claim. Because they're saying, you were withholding all those dollars from us. It's not fair for us to pay the full claim, because smaller claims are a lot more likely than for the whole building to burn down. Right. So the idea is that it's a lot more likely for $1 million building to suffer a $100,000 loss than it is for a $500,000 building to suffer a $100,000 loss, and therefore you should be coughing up the premium to reflect that. So your $100,000 claim, you could only walk away with $50,000 coverage.
So basically, in practical terms, in that case, the building owner would be punished, in effect, for not valuing the building properly when they got their insurance policy.
You could be double punished. The homeowner might only be punished up because the policy only pays to that limit that they had listed. In this policy, we're only going to pay up to what's listed, and that co-insurance penalty could kick in. So you have 2 ways to get punished for that. The way around that, if you have a really, really ideal building, a lot of times we can negotiate an agreed amount with the insurance company. In other words, they're waiving the co-insurance penalty, but they're typically only doing that when they see that you are doing your best effort to insure the value. So you always want to look at the replacement cost. The other thing I see is that replacement costs can change. A lot of homeowner policies have automatic increases built in every year that you renew, whereas a lot of commercial policies don't. They're just stated limit policies. So you'll have a guy who or lady who bought a building 20 years ago and just hasn't revisited their insurance maybe in 15, 20 years. And meanwhile, construction costs have gone up 5, 6, 7, 8 times.
Okay, right. So I just want to back up for a moment. You've used the term endorsement many times, and I should have asked you earlier, what exactly is an endorsement?
So you have a standard insurance contract, and then anytime you add something to that, it's literally they would take a few pieces of paper and slap it onto the back of the policy, and now it'll be like a PDF, to 1 page, 2 page to 5 page that'll get sent to you. But that is considered to amend the existing policy. So I kind of used endorsements in 2 different cases. One of them are extra forms that they add to the policies as like an extra add-on. So a lot of times on a homeowner's policy, you'll see that they've added like whatever value the insured stated as the building value will cover up to 150% of that, which is also called a 50% extended replacement cost.
Okay.
The other endorsements we can make are, if you called me today and said, hey, I saw your video and I realized that this home is actually owned by a trust and I have it under an individual name, I can let the insurance company know when we purchased the contract, it had your individual name on it. And now we get the endorsement or rider that's slapped onto the back of the policy that says, on such and such a date, we hereby do recognize that it's the trustee that owns the property.
So basically, it's kind of like covering your rear end in these little bits and spots that, as you see them pop up after you got a policy.
Yeah, it's a policy change, and it just amends the contract.
Right, amending in a way to basically cover yourself more, though, typically, correct?
Well, I mean, I can see them slap on endorsements that remove coverages too. The typical policy could cover certain kinds of losses, but because of the type of business that you have or the history that you have, the underwriter amends the policy to no longer cover that type of loss.
Okay, so it can work both ways. Got it. Okay. Okay, so moving on, what is something else that commercial, or let's back up for a minute. Something else that building owners need to know when they're shopping for an insurance policy.
I think a lot of people are focused, just like with a home, you're focused on the physical asset that you do see. You want to know that the building will be replaced if something were to happen to it. But remember that this policy is also a two-part policy. Sometimes you could literally be buying two policies for these. Sometimes they are split into a commercial property policy and a general liability policy. But generally, we're purchasing what are called packaged policies, where you have commercial property and general liability coverages packaged onto the same policy. So even though the driver of costs is primarily going to be the property coverage that you have, it is a huge exposure that you should also be considering. How is the general liability coming into play?
Okay. So by general liability, we're talking about kind of similar situations that we mentioned before. Somebody's walking on the property and
slip and fall is a huge one.
Right, slip and fall due to the negligence of the owner. Correct.
Right.
Okay, great. Let me back up for a second. With regards to updating replacement costs, how often should a building owner do that? Yearly? Every 2 years?
Generally, it's something that I like to review with the insureds every year, at least put it on their radar. At least, is this something that we should think about this year? Look at the limit. Nah, I'm not too worried about it. In some markets like San Francisco, New York, where construction costs have just been skyrocketing, it might be a kind of thing like midway through the policy, you realize I didn't think I was worried about it, but now I am. And we can always change. I mean, at any time we can change the replacement cost. Okay. So, it's not something that you have to wait until the policy renewal, but I would say at a minimum, at least do a quick sanity check. And my way of doing the sanity check is to do a quick back of the envelope price per square foot. If I've got, $1 million coverage on a 10,000 square foot building, I know that that's $100 per square foot. And then you just do a quick call if you have to. Do you know any contractors? Pick up the phone book, whatever you got to do. And just ask them, are you replacing buildings these days for $100 a square foot? And if they're telling you, no, we're starting at $300 a square foot, you don't need an estimate at that point to know that you're pretty grossly underinsured.
Got it. So hypothetically, Mike, let's say we get into a trade war with China, talking about the United States. And let's say, for example, some type of construction material that we tend to import in bulk from China, the price of it just goes through the roof, whether it be a particular type of wood or metal or whatever. I'm understanding that would be a type of event that might make you want to revisit the building replacement costs on your policy.
Definitely, especially if it's the kind of building that's super reliant on one of those materials. Like if you have a huge steel frame building, then the price of steel doubled. That would be something that right away you want to take a look at that.
Okay, got it. Mike, tell me about personal and advertising injury.
Good question, Parviz. It's almost like we prepared for this. That's the hot button issue here in the Bay Area where I'm currently focused, and also in my secondary market, Los Angeles. And it's a conversation that Parviz and I are kind of joking about because we've talked about it offline ad nauseum. In litigious markets where we're seeing a lot of wrongful eviction type lawsuits, you definitely must make sure that your general liability policy has a line item called personal and advertising injury. And, if you have, you'll typically see like a $1 million per occurrence, $2 million general aggregate policy in terms of GL. It should be covering you for $1 million per personal and advertising injury.
Okay.
And it's a no-brainer in the Bay Area and Los Angeles. And, wherever the Bay Area and Los Angeles are now, I assume the rest of the country will be following, within the next 10, 20 years.
So just tell me a little bit more, Mike. What exactly does that line item cover, personal and advertising injury?
It's a broad coverage, and I believe slander and libel could even fall into that too on a commercial policy. When it comes to building owners, the number one trigger that I'm seeing for that coverage is the wrongful eviction lawsuits.
Wrongful eviction lawsuits. Okay, so you're an apartment building owner, you own a 10-unit building, and you evict somebody for whatever reason, and they sue you for wrongful eviction. Okay, so that's the type of line item in a policy that could cover the owner of that building against such a lawsuit.
Correct. And the important thing to remember there too, Parviz, is that you could be ultimately innocent of any wrongdoing, but these policies typically have a duty to defend. So even in a frivolous lawsuit, you're going to want coverage. I mean, as you know, even a frivolous lawsuit, you could rack up $100,000 bill very easily.
Absolutely, exactly. So the insurance company there pays for a lawyer like myself or somebody else to come in
Correct.
and defend the lawsuit, right?
And a lot of times, I mean, it's something that you should double check with your carrier if that situation ever does come up. A lot of times, not only will they provide an attorney to fight the case, but they'll provide you to get your own attorney to give you a second opinion on everything too, because your interests in defending that case might not 100% align with the insurance carrier's interests.
That's
The
right.
insurance carrier is typically going to be a lot happier to just do a quick settlement, whereas you might want to be, defending a little bit harder to make sure that other tenants know that you're not just a soft target. So a lot of times, and it's going to come down to the policy language, but many policies do provide for you to have your own counsel, and they'll pay for that as well.
Okay, got it. So this is the type of line item that, particularly if you are a building owner in California or New York, you need to get the magnifying glass out and make sure it's there and it wasn't taken off the policy, right?
Correct, 100%. California, New York, any jurisdiction that is going to be very litigious and have renter-friendly laws. You should have it everywhere, but definitely in areas that are very renter-friendly, it's you don't want to be doing business without that coverage.
Yeah, absolutely, absolutely. Okay, great. Um, what about prices versus rates, Mike?
Good. That's a great question. Typically a lot of people have been afraid to look under the hood of their policies, and they don't have a good sense of exactly how the pricing even happens. It's just kind of like a black box. My risk goes in and some premium gets mysteriously calculated and spit out in the back. What we like to do is really hold your hand to where you realize what the rating factors of your policy are, like replacement costs, number of units, what exactly is the driver of your policy. And then when we've established that, I'd like to find an appropriate market for you that is, giving you the coverages that you need, but at the market competitive prices. So before I think about the total cost of the policy, I want to make sure you're in a market where you do have the best rate. And then I can select within those rates the best possible coverage that we can purchase with the budget that you have to allocate towards risk management.
Okay.
And I like to tell people that, focusing on the price first instead of the rate is kind of like looking at what it costs to fill your car up with gas rather than looking at what the price per gallon of each gas station is. And, if I just always look at what the total cost of gas is and I'm kind of filling up one time when I only needed half a tank, one time when I needed a quarter tank, and one time when I needed a full tank, I could be led astray and think that one gas station was the right gas station for me, whereas I wasn't really looking at the price per gallon.
Okay, so would you say the rate, so to speak, is kind of like the more accurate indicator of the value of the policy you're getting?
Yeah, when we're looking at rates, we're really looking at the price per gallon. And then when I've gotten the best gas station for you with the best price per gallon, and maybe we do look at a few other things like the added fuel additives and things like that. But as long as I've got the gas that you need and I've got it at the best price possible, then we can start to look at what budget do I have, how much do I want to fill up my tank. But when you look at it backwards, I mean, I see a lot of people that not only are we able to save them money, but we're also able to increase their coverage. So a lot of people that haven't shopped for their insurance in 5, 10, 15 years, they're paying too much to cover too little. So a lot of times you really do get slam dunk cases where I can move you to a better rate and increase your coverage, and you're walking out paying less than you used to.
Okay. Okay. Mike, before I go on to my next question, which is going to be when you should decide to report something to the insurance agency, insurance company. Before I get into that, do you have anything else that you want to add about what building owners should be looking for when they're getting a policy?
I mean, other than working with an expert who specializes in that area of insurance, I think we hit all the major bullet points.
Okay, great. And we'll talk about ABO insurance in a quick moment after I ask this question, right? So this is a question that I know for me has come up a ton of times, not in my personal experience, but people asking me, okay? I got into an accident. Um, I have an insurance policy. Let's say it covers me 50,000, 50, it's a 50, 100 policy, 50,000, 100,000 policy. I have a $1,000 deductible, and I'm just using these numbers as examples. And I caused, it's a little fender bender. I caused $1,200 damage, okay, in somebody else's car. So I have a $1,000 deductible. I caused $1,200 in damage. Policy covers it. It's $50,000 policy. Should I report this to my insurance agency, or should I just, bite the bullet and pay out that money to the other guy and not report it to the insurance agency?
Well, if it was a moving violation where you hit someone like on the road while they were driving too, it's a little bit dicier because they could come back later and say that they had some kind of a medical injury. So in
Right.
that case, I'm hesitant to say don't report it. But let's say you opened up your car door and hit the guy next to you in the parking lot, and there was no one in the car. I mean, no one could get hurt in that situation. You just put a big ding in their door. In that case, if it's very, very close to the deductible amount, it's going to be the kind of thing you might want to consider just paying out of pocket if you have the money. It might not be worth increasing your rates for the next 3 to 5 years just to cover $200 difference between your deductible and the damage that you caused.
Now, Mike, is that, before you go on, when you say close to the deductible, do you mean close, but close even if it's over the deductible, but it's close to it?
Yeah, in the case where I described where no one could have been hurt, I just opened up my door and dinged someone else's door who was right next to me. Under the deductible, it's almost like, why are you even reporting it?
Right.
You're going to be paying 100% out of pocket. But what I like to tell people too is a lot of people think that the minute it's over the deductible that they just want to claim it. But what if you caused $550 of damage and your deductible is $500? Are you really going to go through the process of reporting a claim, going through all that hassle, and raising your rates because there was a $50 difference? I mean, you're probably going to want to just pay that out of pocket.
Right. And Mike, you have actually kind of a rough rule of thumb, right, about what amount of damage should cause you to report something to insurance?
On any, and this goes for any insurance policy when there's a deductible involved. And it depends on the person. I mean, if you have a lot of cash on hand, you might go a little bit higher, and if you have less cash on hand, you might go a little bit lower. But a good rule of thumb is the rule of 2x. So if I have a $500 deductible, I'm typically going to not want to report anything under $1,000 in damage. And if I have a $1,000 deductible, I'm typically not going to want to report anything under $2,000 in damage.
Okay.
And the only caveat there again is when there's unknowns, it's you're always going to want to err on the side of caution and report the claim. You don't want, even though you thought there wasn't going to be an injury, but there was a potential, you don't want someone to pop up with a huge medical injury and it's been 3 months since the accident happened. That's going to be a major problem, right?
Right.
But in those kind of cases where, a tree fell and damaged my fence, and I know it's going to cost me $1,500 to replace that fence, and I have a $1,000 homeowner's insurance deductible, am I going to report that? If I have the $1,500, I'm probably better off just replacing that myself.
Okay, great. So by 2x, you mean 2 times, the X standing for 2 times the amount, right?
Correct. Double the deductible.
Okay, got it. So what I'm understanding from you is that across pretty much any type of insurance policy, whether it be homeowners or auto, if there's not potential personal injury involved, if it's just some sort of property damage, that you recommend to your clients that they don't report to insurance and basically have their rates go up unless the damage is roughly at least 2 times what the deductible is going to be.
Correct. And even with the property damage, again, that caveat comes when it's a clear-cut loss. My fence, a tree falls on it, it's pretty easy to know what the damage is. If I have like a water leak or something like that, and I think it's small, but I'm not sure, you always want to err on the side of caution. When you're not sure, make a claim. But when you are sure, and it's, I'm looking at all the damage that could possibly have happened, and I know like within, 5% what it's going to cost to replace this thing, that's when I start to make those decisions about, potentially just deciding to pay 100% out of pocket and not involving my insurance carrier. And Parviz, it's important to remember that that thought process, that logic can be applied when you're selecting your deductible as well. You don't always necessarily wait until the claim happens. I mean, when I'm selecting a deductible, a lot of people think like, well, I'm pretty comfortable covering anything out of pocket that's less than $1,000, so I'll get $1,000 deductible. Well, if all you're able to be comfortable with is paying $1,000, $1,000 deductible is probably too high for you, because when the $1,200 loss comes in, you're going to be, just kind of stuck covering that that was a little bit outside your comfort zone.
Right.
So, if you're only comfortable paying $1,000 for any loss, I recommend a $500 deductible.
Okay.
If you're only comfortable paying $500 for any loss, I recommend a $250 deductible.
Okay. All right. That makes sense. Appreciate that. Okay. So let's move on to a little bit about ABO, Apartment and Building Owners Insurance Agency. Now, as you mentioned earlier in the interview, Mike, you handle personal insurance lines such as auto policies, homeowners policies, but you kind of do that more incident to your main clients, which are basically building and apartment owners. So is that correct? Your focus is on these buildings, and also kind of as a side thing, you tend to help those clients on the personal lines, right?
Yeah, if you have a simple like liability only auto policy, I'm probably not going to be the best guy to walk you through that. I kind of like to look at it when it relates to a larger portfolio, and it could be important. I mean, if you're just getting insurance from any old broker for just your auto, they might not realize all the properties that you have and recommend things to you like a personal umbrella that can cover all your personal properties and your auto, things like that. So they're not going to know a little bit about what you're trying to protect. But yeah, my focus is to start with the building owners, and then I build the whole suite from there.
Okay. Within the building owners, do you have any type of subspecialty or basically some niche that you get a lot of clients in?
Yeah, I love anything that's habitational. So anytime you have buildings that people are living in, and I like mixes. I like when it's a commercial space on the first floor and apartment spaces on top. I love apartment buildings. I love hotels. So I like buildings in general, but I especially love buildings that people are living in.
Okay, so for example, would a hotel in which the owner operator lives in one of the units be the type of client that you really focus on?
Yeah, I have many clients that's exactly the case that's going
on. Okay, great.
Or at least a live-in manager.
What's that?
Or at least we have a live-in manager.
Okay, at least you have a live-in manager. Okay. Anything else about ABO Insurance that you'd like to tell the listeners?
If you've got buildings, you're a landlord, we love to talk to you. I talk to people from 2 to 4 units to 100 units, my typical profile. And they might own, 4 to 8 properties. And I love commercial, I love warehousing, and I especially love any kind of building where there's people living in it. And those are really the properties, especially if they're built prior to 1980, where working with a specialist who really understands all the market players involved can make a huge difference. Like the doctors and dentist office that are all getting Liberty Mutual, Travelers, Hartford policies out there, you can kind of work with any broker that you prefer to work with, and we're not going to really get you that much difference in coverage. But when it comes to buildings that people live in that may be 30, 40, 50, 100 years old, it's going to really, really benefit you to work with a broker who is working with those types of buildings on a daily, weekly basis.
And you are one of those brokers. That is your specialty.
Yeah, I mean, those are risks that I'm looking at every day.
Okay, great. Mike, I think that does it for today's interview. Thanks a lot for this great info and these great tips. To everybody out there, if you liked the video, please make sure to give it a like and share it with anybody that you think might be able to benefit from it. And Mike, as you know, we're going to put this video out on YouTube. So at the risk of flooding your office with telephone calls, can we make your contact info available to anyone?
Please do. I appreciate it. Yeah, please do. I appreciate that.
Okay. Even somebody who's just interested in an auto or homeowner's policy, can they call you?
Feel free to pick my mind for any kind of insurance, and if it's something that I'm not capable of doing, I'm happy to point you in the right direction.
Okay. And where is your office located?
I'm located in Walnut Creek here in the East Bay area,
Okay.
California.
Okay, great. So I'm going to give the telephone number and website right now. We're also going to put it in the notes in the video. So Mike's telephone number is area code 925-683-4233, and the website is www.aboinsurance.com.
Yeah, that's 925-683-4223.
4223. Excuse me. I thought I said that. Okay. Thank you. That's it for today.
Thanks for having me on the speaker series, Parviz.
Thanks, Mike. Take care now.
You too.